Welcome to Real Cash Flow, the only show that takes you full circle with your money, covering stocks, bonds, commodities, currencies, crypto, insurance, and real estate. I'm your host, Andrew Michael Arroyo. Let's get started. Welcome back. Today we are continuing on with our series about real estate investing, and specifically commercial real estate investing, taking a look at syndications, real estate investment trusts, sharing the knowledge that we have accumulated for the last 25 years through 3 market cycles to share with people how to participate. Because many times we can see an opportunity present itself right in front of us. I like to say it like this. Here's my illustration. Think about your favorite store that you love to shop at, no matter what that is, whether it's a clothing store, a sports store, whatever that is. And you get to the store, and in the window, you see a sign, and it says 50% off everything. You would run in that store as quick as possible. It's your favorite store, and you would start to pick up all your favorite items because they're half off. Well, that same situation is happening right now, nationwide, in the commercial real estate space. It's not happening in residential. There's slight discounts, there's a little extended market time, but for the most part, residential is held. Commercial, on the other hand, especially in certain sectors like office and multifamily, is a grand sale going on right before you. And the question is how to participate. That's the challenge. Because unless you have 5, 10, $20 million parked on the sidelines, you can't get in. You can't go buy that piece of property by yourself. And therefore, you need to group together with others or invest in a syndication, a real estate investment trust, and select managers that know what they're doing, that have been through the market cycles, that are not exposed to the purchases of the last 3 or 4 years, that are going to be in a lot of hot water in the next few years because of all the commercial debt that's maturing. So we're going to pick up where we left off, and we're first going to discuss the commercial lending and the fact that they're tightening their standards. What is creating this opportunity? This is not just an opinion. This is rooted in fact. And the opportunity stems from a lot of investors and funds and syndications purchasing assets, specifically office, multifamily, retail, etc., at the peak of the market. And the peak of the market was essentially post-COVID, 2021, 2022. And the reason it was a peak is because interest rates were so low. So as interest rates went low, you could buy a building with what's called positive leverage. That means you could receive a loan at 3% and it was yielding 4% as a cap rate, or 5% in certain markets. But that has now reversed. Interest rates are all the way up at 7 or 8%, yet the cap rates are still lower. And so for this reason, anybody who acquired these large multifamily or office buildings or certain other assets in the commercial space at those ultra low interest rates, they have to refinance typically 5 to 7 years down the road from acquisition. So that date is coming. And this year, next year, the following year, we have billions and billions of commercial real estate loans coming due. They balloon. That means you have to refinance. And in the event that they no longer qualify to be refinanced, meaning the cash flow does not meet the obligations of the debt, well, in that circumstance, you have to sell. And when you go to sell, well, you have to sell a building for what it's worth based on a cap rate. And so now that rates have gone up, well, the cap rates have to follow. So if you bought a building, for example, at 4% cap rate in 2021 and you paid $10 million, well, if today the going rate is 8%, meaning a new investor expects to get 8% because they could get 5 in the bank, they want 8 in order to buy that same building. Well, guess what? Your building is now worth half of what you paid for it. It's an alarming statistic. Most people don't clearly understand how commercial works. But if you want a simple analogy, get online and type in online search, type in how do bonds work, because commercial real estate is very similar to bonds. As yields go up, values go down. That's how bonds work. Well, commercial real estate, same thing. As cap rates go up, yields or the value of the building goes down. And so that's the opportunity that we see over these next few years. So the bottom line is this: many assets are overvalued right now due to a rise in interest rates and inflation. There's significant concern in the market by some of the biggest that are out there, such as Blackstone's Real Estate Investment Trust. That's the largest real estate investment trust in the nation with $130 billion dollars. And it is still assuming high single digit growth rates for its net operating income. And these assumptions have been criticized for having the highest discounted cash flow and cap rate assumptions in the market. But in their public defense, Blackstone has cited that they had increased exit cap rates by more than 18% for rental housing since 2021, December of 2021. And you can read that. That's an article that CoStar published, as a matter of fact. By way of example, if they were assuming a 4% cap rate in December of 2021, they are now assuming a 4.72 cap rate. Meanwhile, the Fed has increased the risk-free rate by 5.25% in that same time period. And inflation has also risen so that the real cap rate, the difference between a property's cap rate minus the inflation rate, has actually dropped. So if all that sounds like a lot of information that's really hard to understand, let me communicate clearly and break it down very, very simply. Think about it this way. If you can park your money in the bank and get 5% for doing nothing, because you can right now, why in the world would you go buy an existing real estate asset that's going to take a lot of hard work, got tenants, evictions, you have roofs, you have toilets, and then only receive 4 or 3%? That would make absolutely no sense, right? Why not just park your money in the bank, collect the 5%, and call it a day? So, for this reason, cap rates need to be above the risk free rate of return. And for this reason, a lot of people are in denial because they don't want to admit that, yes, their buildings that were worth this are now worth that. And so this is the golden opportunity. Now, I'm joined today by Gary Giffin. Gary, you've followed this whole thing and you've been through market cycles with me before. And we are prepared this round to do something very significant. We have a forthcoming real estate investment trust that is launching this fall that will give people the opportunity to invest at these lower prices. So I want to hear your thoughts. I know it's a lot of technical information that I just went over, but hopefully it's clear and you can also clearly articulate the market opportunity.
Yeah, I think what it breaks down to is what can a investor, maybe a small investor that doesn't have 15 to $20 million in their bank account, or nor do they want to take that kind of money and invest in something that could be risky. But I think what you said and all the charts that you've talked about, we're in a prime time to buy some of these properties that we couldn't buy before, and all of these loans that are going to be maturing are going to give us a great opportunity. So we want to pass that on to our clients. I know I do. Somebody that has $150,000, $200,000. What are you going to do with that? Well, how about one of the REITs that Andrew's been talking about, where you can join in with a group of 10, 15 investors and get a great property. And of course, like you said, hey, you can go to the bank right now, credit union, 5% all day long. Put your money in, takes 5 seconds, and you're making 5%. Well, what we're going to be looking at, and I think Andrew, we can talk about this as how about making 10%, and you can talk about the yields that we'll be looking at, but that's more exciting and a lot more fun to double your money with the right property.
Absolutely, Gary. And one of the best situations about real estate investing that does not exist in the other asset classes is the tax efficiency. It's not talked about enough. People don't understand it. They look simply at what the cash flow is going to be, which is super important. But I believe what's more important is what's the net yield, right? The net profit to you post taxes. And most people I know that are in the position to invest this kind of capital, well, they're paying the highest tax rates, right? They're in those higher brackets, both federally and then within the states that they live in. And the bottom line is this: real estate has this golden element. It's called depreciation. And there's certain strategies in which you can accelerate the depreciation, and that's going to lower your tax bill. And commercial real estate, for example, is a 39-year depreciation schedule, meaning when you buy a building over the next 39 years, you can depreciate that. Now, again, we're not giving tax or legal advice. You need to check with your own advisors on these things. But I can tell you from all the money that I've spent with the tax and legal counsel that there's lots of great strategies that are out there. There's great things within the IRS code that allow you to do things like accelerate the depreciation through what's called cost segregation. And there's also benefits like you can look up tax code 199A, which gives you extra incentive if you are in a real estate investment trust for deductions on your tax return if you are one of those high income tax bracket payers. So the tax efficiency, first of all, is huge. There's capital gains as well versus the ordinary income. Obviously, the ordinary income that you receive on a monthly or quarterly basis from your dividend payouts, you're typically going to pay ordinary income tax on that minus that depreciation. However, whenever you do a refinance, that comes out tax free. Essentially, at first you're adjusting your basis, and eventually you're going to have to pay that tax. But whenever you do a sale, you do have the benefit of the capital gains tax, which, today can go anywhere between 15 to 20%, depending on the state that you live in and also the federal tax code. But when you think about that versus so many other assets that you could invest in, well, if you're doing it right, and you have good counsel and you have good CPAs and good managers that you're working with, it should reduce your tax burden and increase your cash flow and your ultimate yield. So, apples to apples, you have to think about that 5% in the bank that you're receiving. Well, it is going to be ordinary income unless you bought a bond and you held it for more than 1 year. So, you're going to pay ordinary income tax, which is going to reduce what the net is to you. It might only be 2 or 3%, depending on what state you live in and the federal tax code. But when you look at commercial real estate, one of the beautiful things is you can do something called a 1031 exchange or even a 721 exchange. And a 721 exchange allows you, they call it an UPREIT. It allows you to actually take your property that you have, an investment property that you have, and exchange it into a real estate investment trust in exchange for those shares. So for people listening that say, look, I am so done with managing my property and tenants and the oversight, or I own residential properties and they just don't kick off a lot of yield at the end of the day. When I think of it cash on cash and the money that I'm receiving after paying property taxes, the bills, the property manager, it's not measuring up to like 5%. It's measuring more like 2% or 3% based on today's value. Well, then it makes a lot of sense to do a 721, or you could even do a 1031 exchange into what's called a DST, a Delaware Statutory Trust. So there's so many things that people can do to improve their cash flow and also reduce the headache of management, but they're just not aware of how to do it. And that's one of the things we're going to be talking about on these upcoming episodes is giving people clear instruction. Again, we're not tax CPAs or attorneys. You do need to check with your own professionals, but we can guide you in the right way so that you can make good, healthy investment decisions based on great tax efficient strategies. So, Gary, let's talk about these investors that are stuck in that residential world, which we know is millions of people across America. They have been prudent, they've been smart, they've saved their money, they have bought some residential real estate because that's all they could buy for themselves, and they own some assets. But at the end of the day, and there's probably been appreciation, which is wonderful, but at the end of the day, they don't yield the same type of returns that commercial do because they were never designed to yield those type of returns. So talk to me about the investors that you work with, the clients that you work with that are looking at opportunities like our forthcoming real estate investment trust, and what excites them about being able to simply write a check and then receive those dividends on a quarterly or monthly basis.
So yeah, Andrew, my clients are going to be very excited when they see this presentation, and we're just now launching this out where we're going to be doing conference calls and Zoom meetings so people can see what's coming down the valley here of commercial real estate, where a lot of clients may just own a home. That might be their only real estate investment, and they're very heavy into stocks, maybe metals or other things. But if you've just sat on your home for the past 10 years, you've actually made money if you decided to sell. Or a lot of my clients have used that leverage from the asset that they're currently living in, and taken money from their homes to buy other things. So this is going to be exciting because this real estate investment that we're talking about, uh, and I know that we're hoping that we can pass on a check to our clients monthly, quarterly, and they'll be able to get into something that they would, drive by and look at and say, "Wow, I wish I could own 20 units." Now this gives them a chance to do that with as little as $100,000, $150,000.
Yeah, one of the beautiful things about a real estate investment trust is that it requires that 90% of all the income is distributed to the shareholders. So it's mandated essentially by the IRS. And again, reflecting back on 25 years and thinking about all the things I would have done differently in investing, although they were successful investments, I think about, wow, the power of cash flow on a monthly basis to gain back our most valuable commodity in life, which is our time. That is really why people want to be in real estate, for that passive cash flow. So my encouragement is this, is certainly we're a resource and we're here to help you and guide you, but find an investment, whether it's with us or another group or in your own personal life, that is kicking you that consistent cash flow that yields you that paycheck that shows up without you having to sacrifice your most valuable commodity in life, which is your time and the hard work. So that is the dream of real estate. It always has been. And here's a golden opportunity to start setting up those dividends so that they start showing up at your doorstep every single quarter or every single month. No matter what it starts out, it can grow as long as the group that you're working with is growing. And what I mean by that is find a situation where there's a new fund, a new real estate investment trust, a new LLC, a basis that's starting now, not something that's already been existing. And the reason I say that is because you are inheriting whatever the portfolio already owns. In our circumstance, why we're very excited and very patient is because we've been waiting for this golden market opportunity to develop our real estate investment trust so that we are starting from a great basis. I learned that in 2008, 9, and 10 when I ran a foreclosure fund during that period of time in San Diego. When that basis is set up properly, boy, you put yourself in a position where the units or the stock price can also grow in addition to you receiving those dividends. And as the fund or the real estate investment trust acquires more and more property, well, your dividend continues to increase, even if you don't continue to put in more and more money. So we will continue on with these episodes, continuing to deliver the education and sharing the knowledge we've accumulated these last 25 years. But as my good friend Don Nava likes to say, information plus application equals transformation. So please do take the information and apply it wherever you see fit, and get with a group that can bless you and watch the transformation in your financial well-being. We hope the message has blessed you, and stay tuned. Many great episodes coming up on real estate investing in the commercial space.